Welcome back, everyone, to NYU Grad's daily podcast on stocks and finance. It is Wednesday, January 3rd, after the market close. Welcome back, everyone. Hope everyone is getting back into the swing of things. Lots to cover today, so let's jump right in. So looking at breadth, nothing too remarkable. It's about even like yesterday. We had 113 new highs and 102 new lows. However, 23% of shares were advancing versus 73% declining. And we still have a manageable 21% of shares under its 50-day moving average and 34% of shares below its 200-day moving average. Both are manageable numbers, nothing to panic over. I would say, with the amount of a rally we've had into the end of 2023, today's action in a vacuum isn't as bad as it seems, right? So the Dow was down 284 points, about 0.75%. The NASDAQ was down 173 points, about 1.18%. And the S&P was down 38 points, down 0.8%. The Russell was down the most, over like 1.5%. But I would say it's manageable too. Hey, no worries. We are so overbought. We need a pullback. But we also had a very ugly Tuesday coming out of the New Year's / Christmas Santa Claus rally. So 2 days in a row that were negative, and it as a totality, the first two trading sessions of 2024 is pretty ugly. So if you're unaware, the Santa Claus rally is not just until Christmas. It's actually, it can extend into like the first 2 days or the first week of the new year. So technically speaking, it only is supposed to be the first 2 trading days. So today would be the last day. But some folks will extend that out to the end of the week. But in textbooks terms, today was the end of the window for the Santa Claus rally. So it's not that great when we've lost over 50% of the Santa Claus rally in the first 2 days of the new year. That's one thing for complexion. And when you take a look at the sectors, the only sector that was positive today was energy. And the only other sector that, there's a few sectors that were not in the heavy red were utilities, communication services, and healthcare. These are all things that are defensive, typically will pay a dividend, and it's kind of indicative of rotation out of risk and into safety. If you take a look at a lot of the healthcare biotech stocks, they were doing decently today. Typically, that's not a good sign. That's just money trying to park into safety. When I take a look at the week's performance, is only 2 days. Healthcare is leading, and then utilities is second. So that's not good. And the biggest loser for the first 2 days is technology, and then consumer cyclical. If you don't know, consumer cyclical is a basket of stocks that are very sensitive to economic tailwinds or headwinds, either way, vice versa. So that's not that great. We're going to need to see how the rest of the week shakes out, but so far it's looking ugly. What else am I going to cover today that stood out? So yesterday on Tuesday, they were picking on Apple on the Barclays downgrade. Today, they picked on Tesla. Tesla was down pretty much all day. I mean, midday during lunchtime, there's usually some type of lunch algo that tries to bounce stocks, but Tesla was weak all day. They're down 4%. They are still above the 50-day So that's good. But yeah, they really beat up Tesla today. So that's something to watch out for. I noticed. I mentioned the Russell was the weakest as well. One of the things that I was watching at around 250 in the afternoon was NYSE advanced decline issues as well as NYSE up and down volume. And at that time, around 250, we were trying to rally. But looking at breadth and the advanced declines, it just looked like it was a very weak rally. And right after, like around 3 o'clock, we sold off into the close and closed near the lows of the day. One thing I did want to actually shout out, I want to shout out Melody Wright. I will post the video that she came out with late the last week of December. It's a really good one. She updates the housing, commercial real estate, and residential real estate markets every month. And this episode was really good because she talks about and focuses in on the increasing inventory on both for sale and for rent in specific markets. And her commentary is excellent if you are following housing or if you have an interest in buying a home or a income property. I would highly recommend you subscribe and follow Melody on Substack as well as on X. What was strong today? You had volatility. You had the US dollar. The 10-year yield was not strong, but it wasn't weak either. It's just kind of sticking at that 3.9%, and it looks to me like it's trying to go above 4. The line in the sand is 4.5% on the 10-year. If the 10-year rallies back to 4.5%, all hell is going to break loose. Our economy is not built for long-term high interest rates or above 4.5% interest rates. What was weak? I mentioned the Russell led down. Anything real estate related was down today. Consumer cyclical was down. Tech was down. I normally don't like to rattle off tickers and companies, but it was a long list today. I am going to share a screenshot of the carnage, but I'll go through a few rapid fire. You had Sweet Green down 7.4%, Affirm down 6.6%, Wayfair down 6.38%. This is all percent. Red Rock Resorts down 6.05%, Crocs down 5.4%, Sprout Social down 4.8%, CarMax down 4.8%, PayPal down 4.6%, Freshpet down 4.5%, Beazer Homes down 4.5%, Carvana down 4.4%, Smartsheet down 4.3%, Delta Airlines down 4.2%, DraftKings down 4.08%, Dollar Tree down 4.08%, Tesla down 4%, Lyft down 4%, Zillow Group down 4%, AI down 3.93%. So you get the picture. It was a pretty ugly day for anything that was in the Russell, that is interest rate sensitive, that's consumer income / lack of money sensitive. Cheesecake Factory down 3.4%. I can just keep going on and on. What to watch? We actually have the ADP numbers coming out in the morning. If you recall, if you follow me on Substack and you listen to the podcast, you know, in this sick world, a good ADP jobs number is bad news. Okay, because the implication is that if we're doing well with our jobs, then the Fed has to stay higher for longer or increase rates again. Because if we make more money, more wealth, then inflation happens. That's the thinking of the central banks. And if the ADP number is bad and we're losing jobs and we're losing income, their interest rate increases are working and inflation is going to come down. So that's coming out on Thursday, tomorrow at 8:15 a.m. Initial jobless claims is coming out at 8:30, and the PMI numbers at 9:45. And then Friday we also have the employment / unemployment rate report and hourly wages at 8:30. Similar theme. The better Main Street is doing, the worse news it is, because then they have to increase the interest rates. We are stuck in this twilight zone right now, and everyone is just basically reacting to the Fed and interest rates. But if you read my Substack before the new year, I have a hunch that in 2024, we might, I'm not saying we will, we might have a condition where yields decouple from the US dollar. If you have questions about that and why that might be very important, send me a comment or email or comment on the Substack episode show notes. Just asking for more clarity. Ask me questions and I'll address them on the next podcast, or I'll just reply right there on the show notes. It was been a pleasure. Have a great evening if you're listening to this Wednesday evening, and I will see you guys after the Thursday session. All right, later.